Hello everyone, a very good morning to all. Welcome to Officers Adda 247 YouTube channel. Today is the morning where we are going to discuss a method that relates to your capital busting chapter. So let's start today's session with a motivational quote that is success is not the final, failure is not fatal, and it is the just courage to continue that actually counts. So I hope this let's start this session with a very beautiful quote. Okay. If you have not downloaded the Adda 247 application, just download this and subscribe the Officers Adda 247 YouTube channel so that you can get notifications of the live sessions, notifications of the live, whatever the important notifications that related to your examination. So you actually get a regular update from your related to your examination. So that's why you should just subscribe the Officers Adda 247 YouTube channel and download the Adda 247 application. Okay. One more update that is, our target batch that actually started from day before yesterday. And you can just enroll in this batch by applying code that is Y422. And with this code, you can just avail a maximum discount on this batch. And this target batch is just for the students that this batch is especially for the English medium aspirant, and this batch is basically for the students, or say that this batch is basically for our colleagues that actually targeting the May to June examination that is scheduled. Okay. And in this batch you will get everything, like you will get to understand basic concepts related to your subject. You will get, like, if I was talking about my subject, like my subject is accounting. Okay. So in accounting subject you will just get everything, like you will just know that what is the basic concept behind every chapter, and you will just understand easy questions, medium questions, advanced level questions, everything you will get in this particular batch. Okay. So I hope you just enroll in this batch, and this is also at very convenient price. Like, you only have to use the code that is Y422, and with this code you can avail the, and you say you can just enroll in this batch. Okay. Okay. So our prices are just set to rise soon, so I think you should just hurry up and you should just grab this opportunity, because now you just get a flat 80%, up to 80% discount you can avail. So don't miss this opportunity and just use a code that is Y422. And okay, now let's start this session with a very important question from the exam point of view. And we actually discuss a present value method, if you just remembered, like net present value method, we are just discussing. So in this question, like in this type of the questions, you have to calculate the present value of any cash flows. Okay. And we just understand till now, that is what is cash flow, what is cash inflow, what is cash outflow, and based on that we are just going to just find out what is the present value of the total cash flow for the second and third year, right? So now what we understand, like discount factor, and what we understand by the discount rate, like and the relationship between the discount factor and the discount rate, that is very important in the chapter of the capital budgeting. Okay. Because if you just understand that is what is difference between the discount factor and what is the actually uses of the discount factor and the discount rate, then this chapter would be cakewalk for you. Okay. So basically, if I am talking about what is the capital budgeting, okay, so capital budgeting is just is just a analysis for your investment, like what project you are just investing, it is worthful or not. That's it. That is a capital budgeting, right? So we actually have to discuss a three method that is very important from the JAIIB exam point of view. So that is net present value method, internal rate of return method, that we actually discussed today, because we actually discussed net present value method in the yesterday chapter, in the yesterday session. Okay. And after that we will discuss the payback method. Okay. So they are basically three that methods that are very important from the JB exam point of view. So now just understand this question and just do this question from your side, and after that we will just discuss this question. Okay, so if I say that the discount factor is given, so what we understand by the discount factor, actually the relationship between the discount factor, that is equal to the 1 divided by the 1 plus r to the power n. Okay, so that is the relationship between the discount factor, and this are actually known as a discount rate. And most of our colleagues just confuse between the discount factor and discount rate. So you have to understand this r is a discount rate, right? You can also say that this discount rate is also known as a expected rate of return. This discount rate is also known as a expected rate of return of an investor, right? So that are denotes the expected rate of return, or say discount rate. So that is basically discount factor. The another important thing that exactly you have to understand, because that formula actually work for your chapter of the bond as well as the capital budgeting, and that formula is very important to memorize. Okay, and there is nothing to memorize if you just understand this, that is present value is equal to future value, and it is divided by the 1 it is divided by the 1 plus r to the power n. Okay, and if I say that this is 1 divided by 1 plus r to the power n, so we can also write in this way, that is present value is equal to future value, and it would be multiplied by the discount factor. Okay, because in the JAIIB examination, the examiner actually want to ask a question that is related to your that is related to your knowledge, not for your calculation. Okay, so now if we have to calculate like we have to calculate here present value of the total cash flow for the second and third year. Okay, so like I always explained you, you always have to understand that is future value is nothing but in the case of the capital busting chapter, you have to understand a future value that is related to your future cash inflow, right? So if I say that if the cash inflow for the second year from a project, that is 10,000 rupees, so you have to understand this question in this way, if I say, suppose that this is an investor, and this investor is just want to invest in any kind of the project. Okay, so the expected rate of return that he just want to get from this project and this project. Okay, and the expected rate of return that he just want, that is 10%, and that actually known as a discount rate as well, right? So suppose that from this project the customer actually getting first year, second year, third year, right? So from in the second year, like in this question, that is second year and third year information is given. Okay, so like in the second year, the customer is just getting a 10,000 rupees from this project, and you have to calculate a present value of this future cash inflow, as well as you have to calculate the present value of the future cash inflow that is related to from the third year. And after that, you have to calculate the what is the present value of the total cash flow. That means you have to calculate a present value for the second year as well as from present value of the third year. That's it. Okay, so you have to calculate this, and discount factor is given in the question. So how you can calculate this? So first you have to calculate for the second year. So if I say what would be the present value, so you have to write that is present value is equal to future value, and discount factor is already given in the question. And we have, if we are calculating for the second year, so how you can calculate that is present value is equal to future value, and it would be multiplied for the discount factor of the second year, because we are just calculating for the second year present value. So present value that is equal to future value, and it would be multiplied by the 0.826, isn't it? Look, for the second year, the discount factor is given the 0.826, so just write 0.826, and future cash inflow that is given 10,000, and it would be multiplied by the 0.826. So what would be the value? That is 8,260 rupees. So that would be your value for the second year. Now come for the third year. So if I'm talking about for the third year, so how you can calculate for the third year? That is present value, again it is future value, or say future cash inflow, and the discount factor. Now the discount factor for the third year, that is given 0.751. So just write here 0.751, And you know, again the future cash inflow that is given 10,000, so just write here 10,000 and it would be multiplied by the 0.751. So your answer that would be for the third year 7,510 rupees. I think it is understandable for everyone. Now, other thing that we have to calculate the total cash flow. So, if I'm talking about total cash flow for the second and third year, that means we have to just sum up this second and third year present value. So, for the second year, if I say that is you will get a present value 8,260, and for the third year, you are getting the present value that is 7,510 rupees. So what would be the value? That is 0, 7, 7 and 50. That means that would be your answer, 15,770 rupees. That would be your total cash flow for the second and third year, and that would be the present value of the total cash flow for the second and third year. So this is how we calculate. So you know, for just including this question, the concept behind for including this question, that you have to understand about the basic formula or say basic relationship between the present value and future value and discount factor and discount rate. I hope it is now clear for everyone. Okay. Now understand another method that is related to your second method. If I say that is internal rate of return, and internal rate of return or say IRR is a important you know, is an important method. If I'm saying that from the exam point of view, you will get a theoretical question based on the IRR method, because IRR method, solving IRR method is just little time consuming, and you will understand how it is a very time consuming method. Okay, so let's understand. So if I'm talking about the internal rate of return or say IRR method, and you know, IRR method is nothing but it is a discount rate that reduces the NPV to zero. That means what we understand by the discount rate, that this is actually the rate that is expected rate of return. Okay, and that expected rate of return at which your net present value would become zero. So that rate is known as the internal rate of return. This is nothing else. Okay, I hope it is understandable for everyone. That means if I'm talking about the discount rate, so that discount rate is also just known as a IRR if it is reduced to the net present value to the zero. Okay, so the rate at which net present value would become zero, that rate is known as the internal rate of return. Okay, understandable for everyone, right? So just understand from the example. If I say, suppose that this is a investor, suppose that this is an investor A, and this investor is actually just want to invest in a particular land. Okay, and just purchase the land for the 10 lakh rupees, right? Just purchase the land for the 10 lakh rupees, or say if I say just purchase a land for the just take another example for this. 1 minute. Okay, so just let's say this investor actually just invest in a land for the 2 lakh rupees. Okay, we actually just reduces the time period, that's why we reduce this amount. Okay, so if an investor is actually just investing in a land, so suppose that purchase a land for 2 lakh rupees, and he actually just want to rent it out this land. Okay, rented out this land. So like he just expecting for renting this land for the 2 years. Okay, so suppose that in the 2 year he actually just going to receive suppose that 4 lakh rupees. Okay, 4 lakh rupees per year, like 4 lakh rupees per year, the you know, 4 lakh rupees per year the cash inflow. Okay, so like in the first year he just actually receiving 4 lakh rupees. In the second year he just receiving the 4 lakh rupees. So we have to calculate a net present value. Okay, so you know, net present value, what we understand by the net present value, net present value is nothing else but minus investment. Why we using the term that is minus investment? Because investment is just a cash outflow for the company. Because this is, suppose that this is a company and this company is actually investing in any project, that means that money is actually gone out from the company. And if that money is gone out from the company, that means it will be considered as a minus investment. Okay, so minus investment plus that is just plus that is present value of all cash inflows. Okay, present value of, or say summation of the present value of the all cash inflow. So that is actually your net present value. Okay, so now if I say, if you have to calculate the net present value, or say you have to calculate the, if I'm talking about the internal rate of return, that means you have to calculate the internal rate of return, or say you have to calculate the discount rate here. Okay, discount rate, or say expected rate of return at which your net present value would become the zero. So now if you're investing 2 lakh rupees, so you will write in this way, that is 2 lakh rupees. Okay, plus now suppose that for the 2 years that this person, or say this investor, is actually receiving a 4 lakh rupees for the first year, 4 lakh rupees for the second year. So how you can just write this information on this way, like 4 lakh, and present value, that is equal to the future value, and it would be divided by the 1 plus r to the power n, if you just remember that. Okay, so 4, and it would be divided by the 1 plus, and we have to just calculate this discount rate at which that net present would become 0. So this value would actually become this 1. Okay, because this n related to your and related to your number of the time period, or say number of the payments, right? So this n is actually related to your time period. So this 4 lakh is again for the second year, and again the 1 plus r divide by the 100, and it would be just to the power of the 2, because it is for the second year. Okay, so now you can just think that how it is very time consuming, like for calculating this, it is very time consuming. So many times, we just see that this based on the IRR method, there are nothing, any questions that asked by the examiner in the JAIIB examination. But if in the case the you will get the questions based on this method, so you just have to use the hit and trial method, or say trial and error method. And by this, suppose that the options are given, this is A, B, C, D. Okay, and 5%, 10%, 15%, 20%, the many multiple options like given in the options, and you have to just use a hit and trial method. And suppose that you just assuming that, that is first, you just assuming that maybe it would be a 10%. So just write here 10% and just solve this, and if you just getting the this all term like 2. Okay, if you are getting the 2, that means minus 2 plus 2, that becomes 0. So that means this 10% would be the correct for this. Okay, this is just an example. Okay, I'm just taking for the example. Suppose that you just pick a 5% and you are not getting the 0, so that would be the wrong for your that would be the wrong for your calculation. So you have to just use a hit and trial method for calculating the internal rate of return. Okay, now I'm also just want to convey you another method, that is interpolation method. Okay, and in the interpolation method, actually your discount factor that actually work for you. Okay, so first of all, just understand some very important concept behind the internal rate of return, and after that I will explain. Okay, so there are some acceptance rules also there for the internal rate of return. Okay, so acceptance rules, if I'm saying what is what we understand by the acceptance rules, so that is you have to just accept any project if the internal rate of return is just greater than the cost of your capital. Okay, if internal rate of return is greater than the cost of capital, then you have to just accept that project, right? And you have to reject the project if your internal rate of return is lesser than the cost of capital. That's it. Okay, so if the internal rate of return percentage is greater than the cost of capital percentage, so that means you have to just accept the project. And if the internal rate of return percentage is lesser than the cost of capital percentage, that means they were the project that would be reject. So that is basically for the we also say, we can also say that a project acceptance rule. Okay, So again, another thing that is important, if the internal rate of return is just greater than your cost of capital, so we can say that the project should be undertaken. And since a rate of return is being earned by the project, and that is greater than the amount that has to be paid out to the providers of the capital. Okay, so that means this project is earning a surplus, or say surplus over and above the cost of the funds, and thus shareholders will be just increase the worth of the capital. So that means we have to just accept this project if the internal rate of return is greater than the cost of capital. And if the internal rate of return is lesser than the cost of capital, then the project should not be undertaken, as going ahead with this project will have the result of reducing the shareholders worth. So that means this is acceptance rules, and this is a very important from your exam point of view. Okay, so as I discussed that it is a very time consuming, like it is very time consuming that you have to use a hit and trial method. Okay, so another method that we have to understand that actually work for the discount factor. Suppose that discount factor is given, and the future value, or say the cash inflow is given, and if from this if the investment is also given, cash inflow is given, discount factor is given. So look, you can easily calculate the net present value. Okay, I hope it is understandable for everyone. First you have to calculate the present value for all the years that is cash inflow is given. After that you have to calculate the net present value, right? Okay, so now we are going to understand another method that we can use for the internal rate of return, that is actually known as the interpolation method. By the way, this is not a very important from the exam point of view, because in the exam you will get a theoretical questions based on this internal rate of return method. But we just have, if we are just studying, we have to understand everything, right? So now we are going to understand about the interpolation method, and how we can just calculate the the internal rate of return from the interpolation method. So suppose that a discount factor is given for the cash inflow, okay, and investment use, just that, okay. So in this interpolation method, you actually use the first, that is net present value, where the net present value is a negative, or say and net present value is a positive. So suppose that at 10%, just suppose that it is just an example that relates to your interpolation method. So for example, suppose that at 10% your net present value is positive. Suppose that, okay. So you are getting, for example, that at 10% a net present value is positive, and let's say it is 5,000 rupees. Okay, so we can actually say that that is net present value. Okay, okay, and suppose that at 12%, if I say at 12% discount rate, at 12% the your NPV, that is just negative. That is just with the negative figure, and it is just a minus 4,000 rupees. So we can say that this NPV is this NPV is just for the your if I say that NPV for the lower rate of return, and this is the net present value that is for the higher rate of return, because this is for the 10% and this is for the 12%. Now the thing that how you can calculate the internal rate of return. So this you can just write the internal rate of return like this, internal rate of return, and that will be equal to your lower plus, okay, lower plus net present value, lower, divide by, or say this would be divided by the net present value lower minus net present value higher, and it would be multiplied by the your higher minus lower. So this is how we actually calculate internal rate of return by using the interpolation method. Okay, so suppose that we have to calculate here, so we just write here that is lower rate of return, that is 10%, plus now the net present value for the lower, that you will get 5,000 rupees. So just write here 5,000, and for the 5,000 here again minus, and this net present value at a higher rate of return, or say expected rate of return, and this is minus 4,000. So if I just write here minus 4,000, so that would become actually plus. So 5,000 plus 4,000, and that would be multiplied for the higher minus lower, and that higher minus lower, that would become 12 minus 10. I hope it is understandable for everyone, right? So now this 10 plus, and now if we are just going to solve this 5,000 multiplied by the 2, that would become 2, that would become 10,000, and this 10,000 divided by the 9,000, if we are just going to solve this like with this way, 5,000 divided by the 9,000, and it will be multiplied by the 2, so that would become the 10 by 9. And if we are further going to solve this, so you will get the answer from this, that is 10 plus 5,000 multiplied by the 2, that is 10,000 divided by the 9,000, and that would be equal to the 1.11. So your answer, that will become 11.11. So that would be your internal rate of return. So this is how we use the interpolation method. So the important concept, now you understand how important that is discount factor, discount rate, future cash inflow, investment. From this you can actually just derive the net present value, and in the examination you have to use the hit and trial method whenever you just getting the options, and like I explained in the previous slide. Okay, and you can also use the interpolation method. Suppose that the discount factors are given, and present value you have to calculate, and the lower net present value, higher net present value, that is given. So from that you can easily calculate these kind of the calculation. I hope it is now clear for everyone. Okay, so that's all for this session. I hope this lecture is useful for you everyone. And again I would like to say that if you have not enrolled in this batch, in this target batch, just enroll in that batch, because that batch is actually important, or say that batch is actually very beneficial for you guys if you're just preparing, if you're just aiming for clearing the JAIIB examination. Okay, so with the code that is Y422, you can just avail the maximum discount, that up to 80%. So just hurry up, because prices are just set to rise soon. So okay, so thanks for watching me here, thanks for joining me here. Like this video if you're liking our effort, share this video to your friends so that maximum number of our colleagues can join with us. Okay, so now we will meet on the tomorrow at the same time.